Hey everyone, and welcome back to The Explainer. Today, we are diving into a genuinely fascinating story straight out of the manufacturing sector. We're looking at Craftsman Automation. Now, on the surface, their Q4 FY26 earnings just look like a story of massive growth. But if you scratch just underneath that surface, you find this incredibly gritty, honestly ruthless story of corporate restructuring. So today, we're going to unpack the actual mechanics of how a business manages to scale up while simultaneously fixing its weakest links. Let's get into it. Here is our roadmap for today. First, we'll look at the financial snapshot. Second, segmenting the business. Third, restructuring the aluminum unit. Fourth, the powertrain growth engine. And finally, number 5, capital, cash, and the future. All right, let's kick things off with Section 1, the financial snapshot, and some truly massive top-line jumps. Looking at the quarter, sales are up a really solid 27%, but you've got to check out the data point right next to it. Net profit absolutely skyrocketed by 73%. Think about that for a second. When your profit is growing at nearly triple the rate of your actual sales, you are looking at a masterclass in operating leverage. They are literally squeezing significantly more bottom-line value out of every single new rupee of revenue that comes through the door. And if we zoom out to look at the full year, the sheer scale of the figures is pretty wild. We're talking 8,690 crore rupees in total sales. That is a massive leap from the 5,690 crore they did the previous year. But what's even better is they've maintained their operating margins at a very stable 15%. So they've set a really solid foundation for us to pop the hood and analyze exactly which parts of the business are actually driving these massive numbers. Moving right along to Section 2, segmenting the business. Let's look at the anatomy of this revenue. This is where it gets super interesting because the whole mix of the business has completely transformed. A massive 60% of their revenue now comes entirely from aluminum products. To put that into perspective, just 4 years ago, aluminum was only 20% of the pie, with powertrain sitting at 27% and industrial at 13%. Craftsman is, for all intents and purposes, an aluminum-first business now. But, and there's always a but, right? Revenue doesn't always automatically equal perfect profitability. Which brings us perfectly to Section 3, restructuring that aluminum unit, and specifically tackling what we'll call the Sunbeam problem. Now, the contrast going on inside this unit is honestly staggering. On one side, you've got their DR Axion unit just running hot. It's at 80 to 85% capacity, completely maxed out, and they're buying up land worth around 150 crore just to handle future greenfield expansion. Great problem to have. But then there's the Sunbeam acquisition. To save Sunbeam, management is taking the highly unusual step of actually shrinking it. They are purposefully dialing back capacity utilization from 70% down to roughly 45 or 50%. Shrink to grow. Sounds crazy, right? Let's see how that actually works. So, what does downsizing to save a business actually look like in practice? Let's strip away the corporate jargon for a second. Management is being absolutely ruthless right now. They are outright firing unprofitable customers. They literally sold off a 30 crore rupee line of low-value business equipment just because it wasn't worth their time anymore. On top of that, they're sitting down with their remaining clients and demanding hard resets on 10 to 15-year-old legacy pricing that just makes zero sense in today's inflationary environment. And crucially, they're enforcing strict aluminum price pass-throughs. Simply put, if a customer won't agree to absorb the fluctuating cost of raw aluminum, Craftsman is just walking away and declining to supply them. It is definitely short-term pain, but it's all for long-term margin gain, and they actually expect to see this tough love start paying off by Q2. And just a quick detour before we leave the aluminum side, take a look at their alloy wheel division. They've hit a 3 million annualized exit run rate, which means they are basically sold out. But instead of just blindly chasing growth and building more capacity, management is hitting the pause button on their phase 2 expansion. They want to carefully monitor raw material pass-throughs and keep an eye on import competition first. Honestly, that is highly disciplined capital allocation in action. All right, let's pivot to Section 4, the powertrain growth engine. It's stable and it's scaling. Right now, the powertrain segment is sitting at a really comfortable 65 to 70% utilization. What that means is they have a massive 20 to 25% headroom to capture immediate market growth without needing to pour in heavy new investments. But the real showstopper here is their finalized order book for large stationary engines. It is a massive $100 million order. Now, because this requires heavy prototyping, the revenue won't actually hit the books until FY29 and FY30, but the foundation for that future cash is firmly locked in today. So you might be wondering, how do they actually lock down deals that big? Well, it all comes down to what we can call their capex mode. You see, Craftsman has been investing incredibly heavily since 2021. If any competitor wanted to replicate their facilities today, it would be an absolute nightmare. Between skyrocketing real estate costs, super expensive equipment, and a US dollar that has essentially doubled over the last couple of decades, Craftsman's historical capital investments act as this impenetrable barrier to entry. They've already paid the price of admission that competitors simply can't afford today. And this moat actually spills right over into their daily operating costs, too. Chairman Srinivasan Ravi dropped a really stark reality check regarding inflation recently. He noted that their contract labor costs are currently sitting at less than $1 an hour, but he fully expects this to double or even triple very soon. But here's the kicker. Because they invested so heavily in high-end automation years ago, they are fundamentally shielded from these impending labor cost spikes. Their older, depreciated robots and automated lines are going to do the heavy lifting. Let's bring it all together in Section 5, Capital, Cash, and the Future. Basically, how are they paying for all this growth? Okay, looking at these full-year metrics, we definitely need to address the elephant in the room. They've got a seriously negative free cash flow of minus 647 crore rupees, sitting right alongside 3,623 crore in debt. At first glance, yeah, that makes investors nervous. But, as always, context is everything. This negative cash flow isn't money down the drain. It's the direct byproduct of a massive working capital spike that was absolutely required to ramp up that booming aluminum division we talked about earlier. And, despite all that heavy spending, they are still delivering a return on capital employed of nearly 14%. Management's mindset here is crystal clear. Sure, they expect debt ratios to naturally drop as revenue scales up and the heavy lifting of their past capex starts paying off. But their immediate priority isn't aggressive debt reduction just for the sake of looking good on paper. Their real priority is managing inflationary operational costs. They are perfectly willing to deploy capital today if it means offsetting the rising costs of manpower, power, and fuel tomorrow. Which really leaves us with one big final question. Craftsman Automation is purposefully shrinking parts of their business just to save margins. They're taking short-term hits to their cash flow, and they are leaning hard on a nearly unbreakable capex moat that took them decades to build. So, are they sacrificing today's cash for tomorrow's total market dominance? Well, when you look at that $100 million order book and the incredibly aggressive margin protections they are enforcing, the answer just might be an absolute yes. Definitely keep a close eye on their upcoming quarters to see how this incredible restructuring plays out. Thanks so much for joining me on this explainer, and keep learning.